Well, it gives me great pleasure now to bring on board Mr. Chris Woods to talk about which way he feels the macros and the micros are headed. Now, when we started the year, the general view was that interest rates will remain low, bond yields will remain low, inflation will not come back, and central banks will not change their policy stance. But Chris, in a sense, was amongst one of the few market experts who said US bond yields will head towards 2% and they will head there very soon. So what a fantastic call, Chris, when you in a sense express your thoughts why inflation will come back and why US bond yields will only rise from where they were in the beginning of the year. So Chris, what to your mind is driving this? Is it growth which has surprised everyone, or this is inflation scare?
Well, I think it's a combination of the two. I think what we saw last quarter in the markets, in the stock markets globally, was a big rotation from out of high PE growth stocks to cyclical value names like bank stocks, energy stocks. And this was a very natural consequence as markets grew increasingly confident with the vaccine rollouts, particularly in America, that growth would come roaring back. And we saw clearly growth forecasts surge. Consensus economists competed to upgrade their growth forecasts. The Fed upgraded its growth forecast. But we've also seen, along with the rise in the bond yields, rising inflation expectations. And so far, the Fed has remained very sanguine in the face of these rising inflation expectations. My view remains what it was at the start of the year. We should expect more yield curve steepening. We should expect more of a rally in cyclical stocks. And we should expect more of a sell-off in the bond market. And the key issue is going to be the key issue for markets in 2021 is how the Fed responds to what I believe is going to be the biggest inflation scare since the early 1980s.
Why do you think US Fed has not responded? Do you think US Fed is not worried about the fact that if interest rates they go higher, they will have to service the debt at a higher level of interest? Why is that not getting addressed by the US Fed?
No, that's true. But the Fed last September announced the results of a strategic review it conducted, and that strategic review led the Fed to say that it will now, going forward, it formally gave itself room to overshoot its 2% inflation target, first and foremost. And second, it formally dispensed with the so-called Phillips curve and the trade-off between unemployment and inflation. So the Fed has said we are willing to overshoot the 2% target, but it has been deliberately vague about how much it can overshoot and for how long. So what I've been telling investors in recent months is it has become critical to watch inflation, market-driven inflation expectations. They've been rising, but in my view, a key level will be when the market-driven inflation expectations reach 2.5%, because at that kind of level, there'll be more pressure on Fed Chairman Powell to be more specific about how much he is willing to overshoot 2% and for how long. Now, we are likely to go above 2% inflation in the next 2 months because of the year-on-year base effect, because we had the collapse a year ago. But going forward, the Fed's formal view is inflation will now then come off. But in my view, there's huge potential for inflation to surprise on the upside if we really come out of this pandemic and the US economy is fully open, because I'm expecting massive pent-up demand to be triggered on a real reopening of the US economy.
Mr. Woods, the basic way to value any stock is that you look at future cash flows. Yields have gone higher, which means even if you are in a growth sector, the future valuations will get compressed and this will impact cash flows. Why is that basic principle of valuation, which is if interest rates they go higher, P multiples should get compressed, is not getting recognized by the markets?
No, it is happening because there's been a big outperformance of cyclical stocks over growth stocks. So it's misleading to look at the overall index. What you can see is the FANG stocks peaked as a percentage of S&P market cap last summer. And if I showed you a chart, you can see that value stocks have significantly outperformed growth stocks. So what's happened is the market's broadened out from those few FANG names, and we've had sectors like bank stocks, energy stocks, having very significant rallies. But to me, even 2% on the 10-year doesn't kill the market, stock market. What matters is the Fed's policy response. But I'm of the view that the Fed, if we see a further sharp rise in bond yields and rise in inflation expectations, the doves on the Fed, and we don't know yet if Mr. Powell will join them, but the doves on the Fed will, in those circumstances, in my view, want to impose what is called yield curve control, where they fix bond yields. Rather similar to what has been happening in Japan since 2016, where they have yield curve control, and also similar to what they have in the Eurozone now. I call the ECB's policy closet yield curve control. They're targeting nominal bond yields, but they're not formally admitting it by buying all these various Eurozone government bonds. Now, what would be the argument to do yield curve control in America? The doves would say we want to lock in bond yields to stop higher bond yields undermining the post-pandemic recovery and thereby undermining us reaching our 2% inflation target. But if they do such a policy, there will also be an unwritten, in my view, another motivation for the policy, but it won't be admitted to in public. That is to keep bond yields from rising, because as you rightly say, with a huge surge in the US fiscal deficit in the last couple of years, higher bond yields will make that deficit unaffordable. I think projections of US fiscal deficit this year are running at, is it around 15%? So a key issue, do they lock in bond yields in America?
Mr. Woods, commodity prices, whether it's steel or copper, whether it is cocoa or sugar, everything has been on a tear. Now, for the first time, the US government has said that we would be spending $2 trillion to boost up America's crumbling infrastructure. A spend towards infrastructure means more demand for steel, cement and commodities. Do you think the bull run in commodities is here to stay?
We could be. What's for sure is I would definitely agree you should already own commodity stocks, and you should maintain positions in commodity stocks like I would own both energy stocks. I think from an Indian standpoint, people need to understand that the oil price can rise more in a fully reopened global economy. And another obvious commodity is copper, where there's a supply constraint. So yes, I'm basically got a positive view on commodities.
What is your view on the US FANG stocks, Mr. Woods, considering that that's where the concentration is? Large part of the S&P is already invested and large amount of global ETF positioning is already overweight US tech stocks. Do you see that reversing? And if that reverses, what happens?
Well, that's what's been going on, Nikun. That's what's been going on in the last few months. So last summer, I said that FANG stocks were peaked as a percentage of S&P market cap. So far, that remains correct as of today. I believe these high PE growth stocks will remain under pressure. But I think another risk to the FANG area is simply growing regulation. So it doesn't mean necessarily they have to collapse, but if they lock in bond yields in America, that will revive the high, that will make the market think that rates can be lower for longer. So that would be good for these stocks. But on the other hand, locking in bond yields in America, if they do it, would be very US dollar bearish, and that would be good for the commodity complex. So in my view, you want to continue to own cyclical stocks. They can continue to outperform in the short term on the reopening trade. The long-term issue of whether inflation comes back will depend on how the Fed responds. Does the Fed turn orthodox, start shrinking the balance sheet, raising rates? If it does do that, the deflationary trend can resume. But if the Fed remains very unorthodox in response to evidence that inflation is coming back, or if the Fed does yield curve control by formally suppressing bond yields and introducing a regime of financial repression, then the conclusion will be that we're moving to a regime change and we're going back to a more inflationary world. Because we've been in a disinflationary world in America since the early 1980s.
Mr. Woods, in your latest note, you mentioned specifically on the rising cases or rising COVID cases in India. What do you think that could be? What do you think the implications of that would be? The reason why I'm asking you this question, Mr. Woods, is that India, in a sense, got a premium positioning because the way COVID numbers reduced earlier this year and late last year, and that, in a sense, was a very large factor why India got large part of global allocation. Do you see that changing now?
I mean, I'm afraid, yes, to me, absolutely. What's remarkable is that India outperformed last quarter in an Asian emerging market context, despite growing evidence in the last month of a sharp rebound in COVID cases. So I've been heavily overweight India in my Asian portfolio, but I've reduced the overweight as of in my Greed and Fear published yesterday, as you mentioned, because there's obviously a growing risk short term in the market, because the cases have picked up a lot, and the rate of ascent in the cases, based on the data I've seen, is more steep than previously, which suggests that there may be the new variant in India, which we've seen in Europe, which is more infectious. But my base case is that India doesn't have another national lockdown.
It's slightly unfortunate, Mr. Woods, but exactly a year ago, we were looking at the same news in terms of the number of COVID cases in India, and financial markets panicked. Now, you always said that markets do not react to the same situation twice. But do you see little bit of reversal happening in Indian markets? Because in the short term, both the psychology and the impact of this actually could be negative on the economy.
No, well, I agree with that. Also, the market, I believe, is taking great comfort from the rapid vaccine rollout in America, which, and the market's assumed, the market's making one major assumption, as am I. If I and the market are both wrong, then we're going to get another collapse. And the assumption the market's making and I'm making is that these vaccines have basic efficacy. Obviously, the problem in India, the vaccine rollout is much less advanced than in the US. Now, the risk is that the vaccine doesn't have efficacy against the new variants. But what I've been told by people who know much more about this than I do is that this new so-called messenger technology you see in vaccines like Moderna and Pfizer's vaccine is very easily tweaked for new variants. So I think that is a key point. But what it means is the developed world's going to roll out this vaccine much more quickly than the developing world. And so that's a positive for countries such as the US and the UK that are leading the way in the vaccine rollout.
Now, post the budget, Mr. Woods, the Indian government has clearly sent a message that they are going to be getting growth back, or they would be focusing on growth by increasing spending. And also they are committed to reduce government ownership in some of the non-strategic sectors. Could that be the differentiating factor for India if you compare India with the rest of the world, because no other country in the world has a promise and a potential of such a strong disinvestment drive?
No, I think the Indian budget was, normally the budget is a bit of an anticlimax, but in this particular year, the Indian budget seems to me of historic dimension. And the key point was not the big surge in the fiscal deficit, which some of the more negative spin put on the budget. The key point is that this is a pro-growth budget because the spending is almost all capex. And so this is a growth-friendly budget. There was no real increase in transfer payments. It's very much capex, so it's very much focused on the long-term growth potential, of increasing the long-term growth potential of India. And the key issue actually is the execution of that infrastructure spending. But to me, it's a very positive budget, and the stock market clearly responded very positively to it.
So if you're so bullish, Mr. Woods, why have you downgraded your outlook on India?
I reduced my overweight very simply because the COVID cases are going up again. So it looks almost inevitable that the big cyclical recovery we've seen in recent months has peaked out for the moment.
You've always liked Indian banks, Mr. Woods, but even though your preference in the past was tilted towards more retail-facing banks, is it time to look at corporate banks? Because if cyclicals do well, that means the bend of the economy again will start moving back towards corporate banks.
No, you own banks, but I mean, I think if you're an Indian domestic investor, you also need to own some stocks which are beneficiary of higher commodity prices, particularly oil prices, because rising of all, apart from COVID, the other biggest macro negative headwind for India in the next year could be a rising oil price. The reason why the oil price can really rise a lot, even from current high levels, is the lack of investment in the energy sphere because of all this anti-fossil fuel sentiment. So we have a very strange situation where oil companies are being encouraged not to invest in oil, but the world still consumes oil. So if the world still consumes oil, but people are encouraged not to invest in it, it means the oil price is going to go up. And the other issue is that shale oil production is declining, in my view, for geological reasons, that they've already exploited it. So I think there's a potential in a fully reopened economy for oil to go into above $100 again. So that, I think, is a headwind for India. So to me, you want to hedge that risk in an Indian equity portfolio.
Mr. Woods, when we spoke last, you were bullish on both gold and Bitcoin. Now, gold is at a multi-year low and Bitcoin is at an all-time high. Why do you think both the assets are moving in a different direction?
No, I'm still long gold, but I should obviously I should have more Bitcoin relative to gold. I put a formal allocation on Bitcoin in my long-term portfolio for pension funds in middle December. I should have done that earlier. The reason I put the formal, but I didn't do it earlier because it wasn't really possible until last year for institutions to own Bitcoin in a sort of institutional compliant manner. But there are now you could now get proper custodianship arrangements for digital assets, which means that institutions can now invest in Bitcoin. And so I put the Bitcoin weighting in December. Clearly, it's a lot higher than that, but I think Bitcoin will still go up a lot more. In fact, I'm expecting Bitcoin to have another bit more, to have another strong gains in the coming quarter. So the problem for gold is that Bitcoin represents an alternative store of value now, which is traditionally the role of gold. And there's also a demographic issue for gold because it seems that millennials are much more interested in buying Bitcoin than buying gold. But in the long run, I don't believe the two assets are mutually exclusive. I think you can own both. But so long as bond yields are rising, gold can remain under pressure.
Mr. Wood, just like we look at asset allocation and we define asset allocation in terms of equity, bond, gold, and real estate, do you think after 5-6 years the asset allocation for everybody would include some crypto?
I see more and more I see this becoming a growing trend. But the most interesting development last year was a company putting Bitcoin on its balance sheet. And that was approved by, I'm referring to this company, NASDAQ listed company, MicroStrategy, which moved all the cash on its balance sheet into Bitcoin. And this was approved by its auditors and more importantly by the SEC. And then we saw Tesla make a similar move. And I think there's potential for other corporates to make that move.
You know, one question I've been wanting to ask you, Mr. Woods, that you travel a lot and yet you are completely glued into the various countries, their monetary policy, the economic policies. How do you manage to keep up to speed with at least half a dozen countries and almost every major region in terms of understanding what is happening specifically to them?
Well, I haven't been traveling in the last year, thank you much. So the answer is I've been basically, since the pandemic happened, I've been basically relying on my experience of having been to so many countries. Otherwise, it would be very difficult. Yeah, so I haven't been to India, I believe, since late 2019. I haven't been in China since late 2019. So in that sense, I'm kind of I'm a bit out of touch.
Mr. Woods, if somebody is in his 20s and he walks up to you and says, Chris, I need an advice on how to get rich. How should I start planning my investing career? How would you respond?
Oh, I think they should be learning about this crypto blockchain world, because this digital world, because I believe it's clearly going to become more and more important. And on a 10-15 year view, it probably represents a bit of an existential risk to the established financial order. So I think they should try and educate themselves on that area as well as the obvious conventional area.
All right, Mr. Woods, really appreciate your time. Stay safe, sir, and thank you for joining us.